Oh, Steve, you're back. Oh, no, that's me. Never mind.
Okay. Morning, everybody.
Good morning.
You know,
Morning,
so
Ruth.
good morning.
Good morning.
Good morning. So we will get started. Um, so what we're going to talk about today is we are going to be looking at the financing portion of the contract. We're going to look at cash purchases, understanding the financing contingency. We're going to talk about seller financing, sale of buyer's property, refinancing uh, another buyer's property, and HELOCs and how they should. And HELOCs are home equity loans. So, any questions about what we're going to talk about today? Okay. Okay. First, they to work on the concrete of my sidewalk. So hopefully it won't be disruptive. So we're going to start with the financing contingency. So in item 8, you have three options. You have cash, you have loans, and you have seller financing, right? So if you have a cash purchase, one of the things you're going to need is proof of funds, correct?
Right.
So, okay. Mortgage loans, we're going to talk about pre-approval of your buyer and pre-qualification of your buyer, the differences between the two. All right. And then we'll talk about the type of financing. Is it going to be conventional? Is it going to be FHA? Is it going to be VA or other? And it's very rare that we have anything that falls into the other category. And then the last piece of it is seller financing. Okay. And this is the amount of money that the seller has agreed to finance for the buyer. And then we'll talk about the terms that have to be negotiated. So next, let's talk about the difference between pre-qualification and pre-approval. So this is just a quick look at this. Now, best practices when you start working with the buyer, when you're pre-qualifying the buyer, what are the questions that you ask a buyer before you start working with them? Can somebody tell me what they are? Yes, no?
Have you been pre-approved for your loan?
Thank you, Alina. Yes. Have you been pre-approved or have you been pre-qualified? So, what do you say to a buyer if they say, no, I haven't done any of those things?
Would you like me to give you a list of a few bankers or mortgage brokers, or are you going to be talking to your own bank?
Exactly. Now, if you're a listing agent and you get a call from a selling agent who wants to schedule a showing with you, do you ever ask the question, how does your buyer intend to purchase the property?
I don't.
You know, some no, some people do, some agents do. But I think you always want to know if you can, if the buyer has been pre-qualified or pre-approved, at least taken some step towards obtaining their financing. So, what is pre-qualification? All right, pre-qualification is a quick estimate of what the buyer might qualify for. It's the first step in the mortgage process and is based mostly on information provided verbally or online, not verified documents. So the lender is going to look at what the buyer is telling them in terms of their income, their debts, so they can determine roughly what the debt to income ratio is. They're going to talk about assets. They may or may not pull the buyer's credit score. Usually they do. If they do, it's not a full credit score pull. It's just a rough estimate of what we think the buyer can qualify for. It's not verified because there aren't any documents provided. So it's good to start early planning, but it's really not enough to make an offer. So you can always tell your buyer that if they're going to go through the pre-qual process, the pre-approval process, certainly on the pre-qualification piece, they don't have to stick with that lender. If, you know, you can use a lender just to get the pre-qual, and if there's someone else that they want to actually work with for the purchase, that's okay, right? But at least
Mhm.
get a pre-qual done. Okay. So what's pre-approval? Pre-approval is stronger. It's a verification of the buyer's financial ability to buy a home. Pre-approval requires a lender to review actual financial documents. That's the difference. Okay. All of the documents are in confidence. Okay. They're provided to the lender in confidence. What the lender is going to look at is they're going to do a hard pull of the credit report, which, as you know, can affect their credit score. All right. It can hit it by a few points. I don't know exactly how many points these days, but it can do that. They're going to look for pay stubs, W-2s, tax returns, bank statements, employment verification, debt to income calculations will be done. And of course, what that means is now you're going to know what your buyer can qualify for, right? So now we can write an offer with some degree of confidence that this buyer is going to prevail and will be able to move through the transaction. So, any questions about the difference between the two? No? Okay. All right. So, financing. The first piece is financing.
I have a
Yes,
question. I'm sorry,
Sure.
this is Carrie. I have a question for you. So I understand pre-qualifying and pre-approval, but what about when they actually go through the entire application process ahead of time? Can you explain that to me? They they didn't. I've heard this a few times where they said, well, we actually went through the entire process. We submitted the application, we went through the process. And when I checked in with the lender, they said they've already completed the entire application. I did have a letter. So how can they do that without having the actual property? They're just going with, I guess.
Oh, no, they do a pre-qualification just as we outlined here on their credit viability. What's their viability as a potential buyer? You don't need to have the property to do that. The property is the next piece, but they can go through their financial pre-qualifications. That's what pre-qualification is. There's no property involved yet. It's an
Right, but
assessment
they
of
said they
their
actually completed
viability.
I'm sorry. They said they actually completed the application so that the application aspect of the,
Well, that's
you
what
know,
you have.
the
Yeah, that's what they have to go through, Kirsten. They have to submit everything to the lender. And
okay, I understand.
it's only related to their financial viability, though.
Okay,
And that's their pre-approval. Once they've submitted all their paperwork and been approved
Right.
by the
That's
lender to purchase a house for X amount of dollars with
right,
X amount of financing.
right.
And
That's
then
their
they can pick a house.
exactly.
okay.
That's the piece
So,
that's missing, Kirsten. That's what pre-approval is, okay?
okay, I guess maybe we can talk because my understanding is once we go under contract, then they have, was it 5 days?
Yeah, we're going to talk about that later on, okay?
Okay,
We're,
I guess
we're
that's my question because they said that they had already met that aspect of
I
the
know, but
contract.
in
Okay,
your, okay, but just, we'll get to that, but just,
okay,
I know the case you're talking about, and in the
okay,
case you're talking about, they wanted to present that as loan approval. And I told you they couldn't do that. It's that there was pre-approval of their financial viability. It did not meet the criteria for loan approval in the contract. That's the difference about what you
okay,
and I are talking about, okay?
okay. Yeah, the lender said it did. So, okay, thank you.
Yeah, okay, okay. So financing. All right. So it's item 8 in the contract. There's a lot to it. Sometimes it can be very confusing to people as we get into the financing piece of it. But if you have a cash transaction, it's a pretty simple thing you need to do. You need to check 8A, that this is a cash transaction with no financing contingency. Okay. Um, so there is no protection for the buyer, okay, and from a purchase point of view, monetary point of view. But the one thing you say, well, all you're going to do is check 8A, but you need to, at some point in the contract, you should put into additional terms when the proof of funds is required. Okay, because on a cash transaction, there has to be proof of funds. So, Alina, I'm going to ask you, when you write a cash transaction, what is the time period that you give the buyer to provide proof of funds?
No more than 5 days.
Right. I would agree with that. Jeff, I know you're on the call. What do you think? Do we not have Jeff?
I'm sorry, ask the question again.
What do you think is, Alina just said 5 days for the buyer to provide proof of funds. I agree with that. What do you think?
Yeah, so you could do that, or you could say with first deposit, right? I've seen a lot of them say, within the 3 days when the first deposit is due, the proof of funds is also due. Anywhere between that, 3 and 5.
Yeah, most of the time, if I get an offer that's cash, proof of funds comes with the offer.
That's what I was gonna say. As a listing agent, as a buyer's agent, I'm gonna submit it with the package.
It makes the offer look stronger when you do that. So
Absolutely.
it's in your buyer's best interest to submit it with it.
Absolutely. I agree 100%, but you need to stipulate that in additional terms as to when it's expected. Okay, so that if the buyer, from a seller's point of view, if the buyer misses the date, then we have a different issue, correct? So, okay. So, okay, when they submit, one of the things I didn't talk about here is when they submit proof of funds. Do you redact, what do you have to redact, or do you not redact anything in what they present to you?
The account number.
Exactly. Exactly. Account numbers. Okay. Anyway, any more questions about cash? Okay, that's the best situation. So Brian brought this up the other day. We were talking about this. So you have a deal that's cash, right? So you're getting through the inspection period and the buyer is intending to move forward. There's nothing from the inspection period or the issues in the inspection period have been resolved. So they're going to move forward. Can the buyer then at that point decide to move from cash to financed? Has anybody had that happen?
I had a buyer do that
Mm-hmm.
and it was no problem, but he wanted it presented as a cash transaction,
Mm-hmm.
but he was going to finance anyway. And
Right.
so he started the, financing process as soon as he felt comfortable during the inspection period.
Yeah. That's exactly right. So that is an option for cash buyers. But they have to understand the seller does not have to approve of that. There doesn't have to be an addendum written. Seller does not have to be in agreement. However, if they don't get the loan, if the buyer does not get the loan, they don't have the protection of the financing contingency. So it is going to revert to a cash transaction and they're going to have to close it as cash. Okay. Everybody clear on that?
Can I go back real quick? Does anyone have a tip for redaction? I have never found a really good. I'll use Canva or something like that. I don't know. Does anyone?
Black magic marker.
Yep. A good black Sharpie will do it for you.
Lauren, you can actually do, if you pull it into dot loop, then you can draw a text box over it and download it and it'll be taken off.
Oh, okay.
I know
Thank
it's a
you.
little bit more work to download, upload, but if you draw just a clear text box or over it and don't put any text in it and then download it, it'll have that blacked out.
Thank you. That's a good tip.
Anybody have any questions about this? Okay. Okay. So when you write an offer that's based on a loan, all right, you're going to work through 8B. So the things that you're going to look at are this contract is contingent upon within 30 days after effective date loan approval. That's the loan approval period, correct? Now, that's the default. It can be more than that. It can be less than that. I would not suggest less than that, certainly. But the default is 30 days. Okay. So during the loan approval period, one, the buyer is obtaining approval of, now this is what you have to know from your buyer. Are they going to apply for a conventional loan, an FHA, a VA, or some other form of financing? Okay. You have to know that. All right. then you have to know, is it going to be a fixed or adjustable rate? You have to know what that is going to be. Most of them today are fixed. I very rarely see an adjustable in this market. Okay. Most of what we see today is fixed. All right. And at the initial interest rate not to exceed. So if left blank, the prevailing rate based upon buyer's creditworthiness. All right. So in this market, we've been leaving it blank. Frank, do you have anything you want to add to that?
Let's see. For FHA, yeah. So if you're really, if your buyer is doing financing and they may be eligible for multiple types of loans, I would you can check all three. Like if they're a veteran and they want to they want to look at other options, maybe conventional and VA. And I typically check the fixed or adjustable rate just in case they want to make a change, so that this way you stay within the terms of an agreement if they make a change. But outside of that, and then make sure you have the appropriate rider to go with it if they decide to go that route.
View on interest rate.
I think interest rates are going to go up a little bit. As far as what I do in the box, I put prevailing. So yeah, prevailing rate, then that way it keeps you covered because of any fluctuation.
Right. That's what I do too. You don't even have to put anything in the box, because if you leave it blank, then it automatically reverts to prevailing rate. Okay. So you're going to set out the terms, all right? And then the last piece is based, and for a term of how many years? So if you leave that space blank, it's going to be for a term of 30 years. Most of the transactions we have that are financed fall into the 30-year term. Sometimes you will see 15, sometimes you will see 20, okay? If you leave it blank, it will be the default, all right? And number two, buyer's mortgage broker or lender having received an appraisal or alternative valuation of the property satisfactory to the lender, if either is required by lender, which is sufficient to meet the terms required to lender to provide financing for buyer and proceed to closing. So as Frank mentioned, though, if you are going to pursue an FHA or a VA loan, then you have to use the rider. Okay. And it is rider E in the addenda section, item 19 of the contract. So you have to add it to the contract by checking that off. Now,
I have a quick question, just a quick question. Just
Sure.
to see, does anybody know what the alternative valuation methods are outside of an appraisal?
No.
Broker price opinion?
Yeah, you can do
Yeah.
the lender can do a BPO, and then there's a difference between an appraisal, or they can order what's commonly called a pencil search. A pencil search is just they pull up the values in an area, and if it falls within a certain category, they can approve the value of the property without having to send out an appraiser. And that's obviously lender specific, and it has to do with the type of loan that the buyer is qualifying for.
Yeah, we sometimes call that a desk evaluation.
Yeah.
So,
Desktop underwriter. You can do it.
We saw those, a lot of those, well, not a lot, but we saw a number of those during the pandemic. So thank you, Frank. I appreciate that. No. So we're working through the process, and your buyer calls you up and says, you know what, I need to change the conventional. It's better for me to move to an FHA or a VA loan. Okay, so you're in the process, you're in the loan approval period, and the buyer comes to you and says, I have to make this change. Okay. Can they do that? Well, the answer is yes. But if they're going to move from a conventional to an FHA or to a VA, all right, now they're going to have participation from the seller. So you're going to have to add, there now has to be an addendum to the contract, and you are going to have to add the rider. Okay, so because under FHA and VA, the seller now can be obligated to financial contributions or lender required repairs. So in that case, the seller does have to get involved. You do have to change the contract. Okay. All right. Now, when you do that, though, this change is a change to the original terms. So technically, that change now is the buyer is no longer covered by the financing contingency. Okay, because that only applied to the original terms that you had in financing. So to protect your buyer, you want to, when you write the addendum and you're incorporating the rider, you want to put a statement in there that the financing contingency applies to protect your buyer. Okay, I mean, it's kind of, it's a fine point, but one that you need to be aware of. Everybody clear? Any questions about that? Okay. All right. So Kirsten touched on this a minute ago. This is one of my favorite things because it did happen to one of my agents. So under line 97, buyer shall make application for financing, and if it's left bank within 5 days after effective date. And they will use good faith and diligent effort to obtain approval of a loan, meeting the financing and appraisal terms of paragraph 8B, 1 and 2, right? And we'll get to the next part of the sentence in a minute. Please make sure that you're aware of this and that when you do your critical dates along with what you're doing with loan approval and escrow and inspection and closing and whatnot, that you pick this up with your buyer, because if they miss this and they make application outside of whatever period of time you put in here, again, the default is 5. In most cases, it stays at 5, but if you're going to make a change, if they miss that date, they are in default of the contract. All right. I had that happen to me. We had a deal, you know, at the time it was a fairly high priced property. Anyway, we were challenged on this by one of the sellers because they had gotten an offer that they really liked, and they really wanted to accept that one. So they were looking for something within the contract that we had that would where we could claim the buyer was in default. And this is what their agent went after. And then they happened to be right. The buyer did not make application within 5 days after the effective date. So the buyer was in default. Fortunately, the seller was not going to go after the escrow. They just wanted to be out of the contract. So a lot of people overlook this. Please don't, because it can come back to bite you. Okay. So the last part of this talks about whether or not the buyer is going to sell another property in order to be considered for loan approval. All right. So if that is the case, then loan approval in that case for loan approval, you have to have rider V attached to the contract. Okay. So which is the sale of buyer's property. So make sure that if that has to happen, you make sure you have rider V attached, and we're going to talk about that a little bit later. Anybody have questions about this? Okay. All right. Now there's lines 102 and 110 in the contract that require actions by the buyers. So it talks about the buyers making good faith and diligent effort to obtain the loan, right? Well, if they don't do that, the buyer can be considered to be in default. So how is diligent effort is defined? What are we talking about? It's not limited, but not limited to providing required documents and information that the lender requires and paying all associated fees and charges. Okay, so through the application process, there's an appraisal fee that has to be paid. Every lender has a series of other fees that they need to have, that they charge through the process, and they have to be paid. If they're not, or they're delinquent in sending in documents and information, then the buyer can be considered in default of the contract. All right. I have had that where there was the listing agent and the seller wanted confirmation that indeed the buyer was acting in good faith. So we had to go back to the lender and get dates and times and things like that, and a statement that all fees and charges have been paid. Okay. The next one, buyer upon written request will keep the seller and broker informed about the status of the loan process, including any property-related conditions. The seller only has to make one request. They don't have to send in a written request for every time they want an update on status. They just have to do it once if they want to be periodically advised. Okay. The next one is buyer authorizes buyer's mortgage lender and closing agent to disclose status and release preliminary and final executed closing documents as appropriate to the seller and broker. All right. So this really, where this becomes, I won't say an issue, but is early in the process where we want to understand, one, are they working in good faith and diligent effort? Is the buyer getting everything to the lender on a timely basis? Are there any issues? Well, as you probably all know, most lenders, when asked to provide the information, is going to say probably no, because they are not a party to the contract. And they're absolutely right in that case. So it does happen from time to time where we want some more visibility, but don't be surprised if the lender does refuse to do that. So we've talked about property-related conditions here. We've touched on a little bit. Those are lender requirements tied to the home's condition, value, safety, and marketability. So if there is an issue and the lender is going to bring it up, again, that's something that you have to be aware of, and it has to be satisfied. Okay. Questions about any of this? Okay. Okay. So now we get into some of the specifics about the loan approval period. So we start with paragraph 3. All right. If within the loan approval period, buyer obtains loan approval, buyer shall notify the seller of same in writing prior to expiration of the loan approval period. All right. Or if buyer is unable to obtain loan approval within loan approval period, but buyer is satisfied with buyer's ability to obtain loan approval and proceed to closing, buyer shall deliver written notice to the seller confirming same prior to the expiration of the loan approval. Please remember that the loan approval period ends at 11:59 p.m. on the last day of the loan approval period, not midnight. Okay. So the best advice that any of us can give you is don't wait to the last day of the loan approval period to be working on issues with this. You need to be on top of this from the first day, okay, from the effective date moving forward. Don't let issues linger. You know, you have to make sure that you educate your buyer on the process, what they need to do. Don't let this run to the last day of the loan approval period. You need to stay on top of it and get resolution prior to the last day, right? I had an unfortunate situation with an agent who let it run, went to bed at 10 o'clock, okay? 11:59 comes and goes, right? Didn't resolve it. Of course, then we ran into a lot of different issues. But so please stay on top of it. Also remember that item F on page 8, item F is time in the contract. So if we remember too, other than acceptance and effective date, all right, anything that ends on a weekend, Saturday, Sunday, or a legal holiday falls over to the next calendar day. All right. So this is one of those things that if your loan approval falls on a Saturday, Sunday, or legal holiday, it's going to fall over to the next calendar day. Right. So what is written approval from the lender? Okay. Well, the buyer needs to get that in sufficient time for you as their agent to deliver written notice to the seller prior to the expiration of the loan approval period. All right. So again, if you get notice from your buyer, but you fail to deliver it to the listing agent prior to 11:59, we've got a problem. Okay. Okay. So what is written notice? Right. As the buyer's agent, you're only required to send an email to the listing agent stating that loan approval, whatever the date is, for John and Mary Smith for the purchase of the property located at 123 Main Street has been received. But that email has to be delivered prior to expiration of the loan approval period. You do not send the actual document from the lender, just an email. Everybody okay on that? Okay, you're very quiet today, so. So in paragraph 3, it also states that if the buyer is unable to receive loan approval within the loan approval period, but is satisfied that they'll be able to and proceed to closing, then the buyer must deliver written notice confirming such to the seller prior to expiration of the loan approval period. Okay, so your buyer has been working through the process with the lender. There may be some issues, there may be a delay in getting documentation, whatever it is, but the buyer feels very comfortable that they are going to get loan approval. They're not that concerned about it. So if that's the case, then they have to send you notice, an email saying, okay, I'm not going to be able to satisfy this by the loan approval period, but I am satisfied that I'm not going to have a problem. I will get loan approval. So I do want to move forward to closing. Okay. Is everybody clear on that? Has anybody had that happen? Yes,
I
Jeff.
only know of one instance that it happened.
And how'd it work out?
Not well for the buyer.
Okay, why?
I don't know. I just heard about the instance.
Okay. Jeff, did you want to say something? I can't hear you. You're muted.
I just want to say that I want to make sure that you, as a selling agent, right? Selling agent's the one that works with a buyer. You, as a selling agent, get that in writing from your buyer. I don't want you to have them tell you over the phone, yeah, we got loan approval, right? And then you put it in writing, right? You make them put it in writing to you, and then you can put it in writing to them just to make sure that you're covered, that you actually have written authorization from them to say that, hey, we've got loan approval, or we don't need loan approval, but we're still moving forward.
Exactly.
Can I add one more thing?
Sure.
Okay, so, which Jeff is absolutely right, is getting it in writing, but
Mhm.
every loan approval you get is going to be conditional, right? So
Right.
they're always going to say conditional, and I've had a lot of agents ask about why, it says conditional. Does that mean that we're not approved or anything? Every lender will have a condition to the closing, and the most common one that you'll see is the quality control review. So that gives the lender the option of waiting right until the end of the closing, right at the closing table, to pull another credit report and see if there's any changes to the buyer's ability to purchase in their debt to income ratio, which is the most common reason that would happen. So a conditional loan approval is an approval. It just has the lender's conditions on there. And there may be some other conditions on there too. There could be verification of employment, verification of income, something that may be missing. It really depends on the lender or the broker in submitting certain things. But if it says conditional loan approval, that's good.
Yep.
And
Yeah, I'm sorry, go ahead.
this Trish, I'm a little confused with that because Brian, in several of our Wednesday morning meetings, has been very specific about if it has a condition, it's not an approval. So, but they do all have conditions, every one I've ever gotten. And I always make sure I request a approval letter from the lender. Not just an email saying, yeah, okay, they've been approved. I get a letter on their letterhead. But they all have conditions, but Brian has always been very specific about that.
Mhm.
So is it a loan approval if it has conditions?
I think he may have been misunderstood or
No,
misrepresented.
he's always been very specific that if a loan letter has a condition, then it's not a loan approval.
They all have conditions. You don't even really need the letter. What you need is a statement from the buyer that says, we've got loan approval, right? You can take that piece of paper and wad it up and throw it in the trash. What's important is your buyer has unilaterally decided, hey, based on the information I got from the bank and what I've got in writing and what I know and the rumors I've heard, I'm good to go. I've got my loan approval, whether it's conditional or unconditional. You know, they all have conditions. Like one of the conditions is that the title policy be placed. I mean, you know,
Right.
there's standard conditions, just like there is in a title policy
Right,
for the title policy. So, you
okay,
know, they made this, when they wrote this way, they made it very difficult for us to be able to explain to our customers. But if you simply look at it as the buyer has given you in writing loan approval, Trish, because if the lender gives you that conditional approval and you don't get that statement from the buyer,
I have
who
never,
just,
ever, since I've worked for Sam, gotten a letter, anything from the buyer. I always get a loan
You need
approval letter from the
you-
lender. That's all I've ever
so,
done.
so you've decided that the buyer's waiving their loan approval,
yeah,
based on what the
Well,
bank
no,
is
that's
telling
what
you.
Sam has always told
Yeah.
me I had to have.
I know, but what we're telling you is Jeff is absolutely right. What we want is what the buyer is going to put forward as loan approval. They're stating to you, I have loan approval. By their statement, they have satisfied the requirement in the contract.
Yeah. And just so you understand, I want to make it very clear. Conditional loan approval on that letter is not to protect the buyer, it's to protect the lender.
Right,
Absolutely.
right, absolutely. I agree.
So
But I have
that,
never gotten any, what do I just, will an email do from the buyer saying, okay, I got loan
Yes,
approval?
yeah.
Yes,
I have
yes.
never done that before, but I'll put it
I'm
on
not
my
telling you to
list.
change your
We're not,
process with Sam. Ruth can talk to
I'll
Sam, or
talk to
I can
Sam.
talk to Sam, but we just don't want you to be making a judgment call on behalf of the buyer.
Yeah,
Correct.
well, I've just never ever done that. That's
Okay.
something new to me.
Well, all right, Trish, I will do this. I will, after we're done sometime today, I'll give Sam a call and I'll talk to him.
Okay, okay,
Okay. All right. And what I did put here is in line exactly with what we're talking about is what we receive is a written approval from the lender. This is what the buyer is getting,
so
confirming.
do I get both?
No, you
The
don't
letter
need
from the
both.
lender and the
No.
email from the buyer?
We just told you, just an email from the buyer
the
stating
buyer.
that they have loan approval.
Okay,
Okay. All right.
I have
So,
a question.
sure.
Sorry. If we're representing the seller and we get that second letter or that second option letter from the buyer saying that they are confident that they can, but they have not received loan approval, what are they truly obligated to the seller at that point? Is there a new timeline that we place on that or what?
Moving forward to closing.
Okay,
Nothing
that's all.
nothing changes in the contract. Contract stays the same.
If we don't receive anything
We're going to
as
get
the
to that.
listing agent,
Lauren, oh, I'm sorry. You mean in terms of loan approval?
yeah,
Mhm.
what if
We're
they
gonna-
are like,
we're
oh,
gonna-
we don't know.
Okay, Lauren, we're going to talk about that in a minute.
Oh,
Okay.
okay, because
If-
Sam just was standing here and he said, if we don't get anything, that's it. If the time goes by, then it
Well, we're
considered
good.
approved.
We're going to get to that portion of the financing contingency in a minute. You're kind of
Okay.
jumping ahead of where we're going with this.
Okay.
Okay. All right. So in line with exactly what Jeff and Frank and I have told you, okay, is loan approval letters, whatever is coming from the lender to the buyer, are going to have conditions attached to it. All right. And that's what we talk about here. All right. So subject to limited standard conditions like appraisals, title, verification of information, underwriting conditions, which Frank is referring to as quality control. All right. But just remember, this is not a clear to close. I had an agent come up to me, I guess a week or so ago. Oh, I've got clear to close. What do you mean you have clear to close? You're not through the contract yet. Oh, I got the loan approval. That's not clear to close. Okay. Okay. Loan approval that requires a buyer to sell another real property in order to qualify, okay, shall not be considered loan approval unless, and it's in the contract, we referenced it a minute ago, unless you have added rider V, sale of buyer's property, to the contract. Okay. All right. Okay. Item 4. If buyer is unable to obtain loan approval within the loan approval period or cannot timely, excuse me, cannot timely satisfy or meet the terms of the loan approval, after all after exercise of good faith and diligent effort. Buyer may terminate this contract by delivering written notice of termination to seller prior to expiration of loan approval period, whereupon provided buyer is not in default under the terms. So as long as the buyer is not in default under another term of the contract, the buyer shall be refunded deposit and both parties are released from the contract. So this is a situation where the buyer is just unable to get loan approval. They're not going to qualify. So again, now we have to have a statement from the buyer that they cannot meet they're not going to qualify for a loan approval. Okay. They've tried everything and now they're going to have to terminate the contract. In that case, we have to have what? A release for an email and a release and cancellation form has to be executed prior to expiration of the loan approval period. All right. Is everybody clear that you have to have a release and cancellation form signed by both parties?
What happens if one party refuses to sign?
Well, we've had that too, haven't we, Frank?
That's why I'm bringing it up.
Okay. And since you brought it up, what's your answer to that question?
Okay, so as long as we have validation that the cancellation has been sent to the party, okay, really the most important thing is to have the seller's signature on there. If the buyer refuses to sign, you can simply put on there, buyer refused to sign. And if just make sure that if there is then a dispute, okay, then we have to do what's called EDO or escrow disbursement order request with FREC, unless escrow is with a title company. If the escrow is being held by an attorney, then it's their problem, not ours. But the cancellation form, you can put buyer refused to sign, which is usually the most common situation.
But seller refused.
You mean
the
seller refused to?
I'm sorry,
the seller
refused to sign. My bad.
Right. Right.
And in that case, make sure that you have all your I's dotted and T's crossed, and that communication has been submitted appropriately to conform with the contract terms.
Right. It will fall under item 16, dispute and resolution. Okay. Item 16, if the seller refuses to sign, it's going to default to that provision in the contract. Okay. So hopefully that doesn't happen. But again, it's the buyer that's going to initiate that release and cancellation form. Again, it has to happen prior to the loan approval period, not afterwards. Okay. Okay.
Hey
Questions
Ruth,
about
this
that?
is Jill. They can also, right, the buyer could also ask for an extension of a couple of days, which the seller would have to agree to.
For the loan approval period?
Yes.
Yes.
Mm-hmm.
Yeah, but the seller would have to agree to that.
Why
Yes.
would they have to agree to it?
They don't have to agree to it. They would have to agree for it to actually extend.
Right.
Yeah, because it's going to expire on its own. But the seller, you can write an addendum and extend the loan approval period if the seller is going to agree.
Yes.
Yes, we've had that a couple of times too. So, okay, clear on that. So if you have any kind of dispute on the contract, doesn't matter what kind of a dispute, anything defaults to item 16. Okay. All right. All right. Item 5. Buyer fails to timely deliver. I think this was Lauren that brought this up. What happens if we don't hear from anybody? Okay. So the loan approval period ends. We don't get anything from anybody. It just ends. So the buyer fails to timely deliver any written notice, okay, as required under 3 and 4, which we just talked about, okay? So nothing has come from the buyer. Everybody's been silent. Nothing's gone to the seller prior to expiration of the loan approval period. And so what happens then? Then the buyer shall proceed forward with the contract as though paragraph 8A above has been checked. So the financing contingency has just been waived and 8A is cash. So now this transaction has just converted to a cash transaction. Okay. And this buyer has to move to closing. However, in this scenario, okay, the seller can elect to terminate the contract by delivering written notice of termination to the buyer within 3 days after expiration of the loan approval period. So this is a portion of the contract where the seller can act unilaterally to terminate the contract, but it has to be within 3 days of the expiration date of the loan approval period. In that case, if the seller exercises their right, then the buyer will not be considered in default and they will get their deposits back. Okay? Has anybody had that happen to them?
Yes.
Yes. And
Not in this market. In a market in Naples, it was very aggressive and prices were
Mhm.
going up and the guy could get more.
Right. Right. So again, written notice, if that's the case, the seller wants to get out of the contract, they have to work within that time frame, and there has to be written notice. Okay. The buyer also has to be, if the seller's not going to act, the buyer has to understand that they are moving to closing. They're not protected anymore, and this is now considered a cash transaction. Okay.
Most of your competition doesn't understand this,
No.
and you can use that to your advantage.
Mhm.
There's so much malpractice on this whole section of the contract. You really, if you know what you're doing, you really can use it to your advantage.
Absolutely. And so, all right. So the last piece of this is item 6. All right. So the buyer has timely provided either written notice provided for as required in the contract, and the buyer hereafter fails to close the contract. Okay, unless the deposit will be paid to the seller if the buyer has defaulted somewhere along the line. But if that's not the case and the contract can't close due to the following issues: seller's default or inability to satisfy other contingencies. So what would that be? What would cause the seller to be in default of the contract?
Title cloud.
Title cloud, repairs that were supposed to be done, things like that. Okay. 2, property-related conditions of the loan approval, which weren't resolved. Okay. In the old prior contract, it used to have a third one, which was failure of the lending institution, but that is now out of this. So those are the cases where no fault of the buyer, but the transaction can't close, but not due to any issues of the buyer. So in that case, the buyer will be refunded their deposit, okay, and released from the contract. Seller financing. So on seller financing, you're going to go to line 133 and you're going to check purchase money note and mortgage. Okay. And you have to, if you're going to have seller financing, then you check 133, but you also have to go to item 19, addenda, and check seller financing. Okay. And this is what seller financing looks like. All right. This is the rider. Okay. It's 2 pages. Page 1 is just all of the information regarding the Dodd-Frank Act that went into effect, I think, in like 2014, to provide transparency with regard to this process and the limitations on the seller with regard to how many properties they can sell or finance and things like that. Okay, so page 1 is informational. Page 2 is where you need to complete page 2, and the things you're going to need is: what is the dollar amount that the seller is going to finance, what interest rate is going to prevail, what's the term of the loan with the seller, and then we have to do an amortization schedule to determine what the monthly and balloon payment is going to be. Okay, typically it's a 30-year amortization schedule that's used, and the default actually in the seller financing rider is 30 years. So we're going to take a look at that. At closing, when you go to closing, it's going to be the closing agent that is actually going to do the note, okay, for both parties to sign.
I was going to say the biggest error I've seen when using the seller financing rider is not including an amortization schedule.
Right.
Okay. I've seen a lot of agents do that, and that's a big black hole you're falling into.
So we're going to talk about that black hole in a minute. Now, I've seen other agents not use the rider, and even though I don't address it here, and write into additional terms that the seller is going to finance X amount and it's going to be at X percentage and it's going to be amortized over 30 years with the balloon payment, and it's going to be a 5-year loan with a balloon payment at 60 months, whatever. There are agents who write it into additional terms as well. Okay, so it can be done that way.
What happens when you do that though?
I know a lot of things happen when you do that. I don't like it because I think it's too loose, actually. I just don't. If you want to expand upon that, go ahead.
If you start writing your own terms, if you start writing terms into the contract and it's you doing it, you could fall into a problem of acting as a mortgage broker without having a license.
You could.
So depending on how you word it. If I copy the terms as stated in the seller financing addendum, and I'm doing it word for word, that's one thing. But if I start getting creative with the financing, that can be a problem.
I agree with you. So, and we're only going to address the financing rider here today. So this is second page. A lot of it you probably will never get into it because there are things that talk about adjustable rates and all kinds of things. So when we utilize this rider, typically this is the portion that we use. So the first thing we're talking about is normally this is a first purchase money mortgage, not usually a second, but you have to identify it either way. Then we're going to put in the buyer and the principal amount. Okay, this is the amount that is going to be financed by the seller, and at the interest rate. Okay. So you'll have to fill that in. And now we're going to talk about typically an amortization schedule. The default is 30 years, and it's typically what we use. Okay. And then there's usually default, the balloon payment rather, at the end of the term. Most of these, again, this default is 5 years, 60 months, and most of them are written that way. Some are written a little bit longer, some are a little bit shorter, right? And then you have to know what the balloon payment would be at the end. Let's say it's a 5-year term, 60 months, you have to know what the balloon payment is going to be. So, and what Frank is absolutely right. So, but what you have to do then, there has to be an amortization schedule. Okay. Do any of you know how to do that?
I'll add one quick question, one quick statement about the amortization schedule. As from a sales perspective, the amortization schedule is what sells seller financing, right?
Mhm.
Because it shows the seller how much more money they would get by holding the financing and collecting that interest on top of the payment, right? There is a risk, of course, okay?
Sure.
But that's a big selling point. So if you don't include it, that's a loss of presenting the offer in its best light.
Where do you find an amortization schedule? Well, there are a lot of places that you can go to do that. You can go online, you can find them all over the place, but you can also go into Flex and you can get it there. So if you go into the main menu of Flex and you go down to calculators, if you open that up, you'll find the amortization schedule. All right. So what I didn't put here is that you have to scroll down to the bottom of the page and hit run report. So when you hit run report, okay, this is what will come up. All right, except where am I? Where's my, I am missing a page.
Yeah, looks like you're missing a slide there.
I am missing a slide. Where is it? I am missing a slide. I'm missing the slide that.
Where you enter in the terms.
Yeah, where you enter in the terms. I'm missing that slide. I don't know where it is. It should be, it was here somewhere, so it's missing. But when you hit the amortization schedule, the slide cut where is it? I apologize to that, but I am missing a slide. Anyway, what comes up is you'll see a screen that you just put in the principal amount, you put in the interest rate, the amortization schedule, and how many months. In this case, I'm using 5 years because that's the default. And it automatically, then you hit run report, and then it automatically comes up with the amortization schedule and the payment amount per month. So here's the principal amount, here's the payments per year, going to be 12. We're going this based on 360 payments. It's going to run it out. This is the interest rate that I put in, 6% and amortization over 30 years. Date of first payment, we made it today. So it will do a full amortization schedule all the way out. So here's your monthly payment. It's $1,199.10, but we want the balloon. We want this only to run because it'll run a full schedule. But in this case, it's a 60-month balloon. So we're going to go down to payment 60. And here it is. And it will give you what the balloon payment is due, $187,307.90. Okay. And I apologize for that one screen missing, that one slide missing.
So the slide that you're missing is between this balloon payment and the previous and this report.
Yeah, it's between the report.
Okay.
It's the actual screen that comes in where you put in the information and then you hit run the report and it runs it.
Okay, so this is amortized for 30 years, but a balloon in 5.
Yes.
Okay.
Hey Ruth,
Okay.
Phil Kravitz has a listing out there where he has the payments that are not even the payments, but he has the seller financing in there, but they change every 2 years, they change the interest rate. Is there any way that an amortization schedule can be created that way? Like it's 2.4% for the first 2 years and 2.8% for years 3 and 4, and then the 5th year it's 2.9%. I mean, they're great interest rates, but it changes in the first
There's
5 years,
online
and then a balloon payment.
There's online calculators that'll do that, Jill.
Okay.
Yeah.
One in Flex.
This one won't.
Oh yeah, that's what I was
No, this
thinking.
one won't. This is just a straight amortization rate.
Okay.
All right. All right. Again, I apologize for the missing slide. It will be in the final slide deck that goes into Bay. Okay, questions about that? Okay, so the next one we're going to talk about is sale of buyer's property and refinancing and HELOCs. So if we're going to have a sale of a buyer's property that is part of the transaction, then you have to use Rider V. We talked about it a little while ago. You have to add it as one of the addendums in item 19. All right, so I'm sure many of you have probably already used this. It's going to talk about the address of the property that we're talking about. Okay. And upon entering into a contract for the sale of the buyer's property, the buyer shall give seller a copy of such contract with the third party's identification and purchase price information obliterated. If we're only looking to demonstrate that the other property is under contract. If the sale of the buyer's property does not close by whatever the closing date is, buyer may, within 3 days thereafter, deliver written notice to the seller terminating this contract. So again, you have to keep track of that date and make sure your buyer is aware that if it fails to close, there is a 3-day window that they have to comply with to deliver notice and then terminate the contract and be able to have their escrow returned to them. Okay. All right. If they don't do that, the last sentence says the contingency has no further force or effect. So what has it done? Okay, it's taken this contingency out and the buyer has to move to closing or lose their deposit. The last paragraph, buyer's property is or is not presently under contract for sale. If buyer's property is under contract at the time this offer is made, buyer shall provide seller a copy of the contract with third party's ID and purchase price information obliterated, simultaneously with the original signed contract submitted to the seller from buyer or not later than 24 hours after buyer's offer is delivered to the seller. So now there's an obligation that if it is under contract, the information has to be provided no later than 24 hours after the buyer's offer is delivered to the seller. Okay. All right. A lot of people miss that final sentence. Okay. Unless we have questions about that, we'll talk about refinancing. So this happens a lot too. You know, the buyer's not going to sell another property, but they're going to refinance another property, and they're going to take the funds from that in order to purchase this new property, right? Okay. So if that's the case, we don't have a writer for that. We don't have anything. So we have to add language to the contract to, again, protect the buyer. So this is some sample language. I was going to talk to one of our attorneys to run it past them and maybe get a little better language than this. But you need something that says the contract is contingent on the successful completion of the refinancing of the buyer's property, and again, the address. Buyer will provide updates to the seller with regard to the progress of the refinancing. Buyer shall use reasonable diligence to finalize the refinance. If the refinance does not close on or before X, buyer may terminate the contract by delivering written notice to the seller prior to the deadline, in which event the deposit shall be returned to the buyer and parties shall, will be released from further obligations. Okay. But if they don't, then the contingency is waived and they have to move for closing. So you have to put language in the additional terms if there is a refinance. Okay. Under no circumstances, okay, do you check financing in the contract if this is the only financing that's going on. Okay. Let's say it's a cash deal, but we need money out of the other property to move forward. This doesn't fall under financing in item 8. I had a couple agents who said, well, yeah, we're refinancing another property, so I'm checking off the financing contingency. No, the financing contingency only applies to a loan taken on the property that is being purchased, not a refinance or home equity loan on another property. Okay. And we have similar language if the buyer is taking a home equity loan, otherwise known as a HELOC. Okay. It's essentially the same language. All right. So that has to go into the contract. So if you're going to do either one of these things, you need to protect your buyer. Okay. Any questions about any of this? Any questions about what we've covered today?
Can I add maybe some
Yes, you can.
history, and so that this way people understand why these things are needed?
You certainly can.
Okay, so why is all of this needed? Why does it have to be in writing? Why is it? Why do you have to be so careful with how you put your contract together? So the contracts, especially real estate contracts, fall under what's called the statute of frauds. The statute of frauds is what dictates what makes a contract enforceable, right? So the contract, in order for it to be enforceable, has to have certain items within it to be sure that that contract is is enforceable. So what are those things, real quick? One, it has to be in writing. Well, real estate contracts have to be in writing. It has to have two parties. It has to have a buyer and a seller. Okay, the names of the buyers and the seller have to be on the contract. It has to have consideration. What is consideration? Means that money, a car, trading properties, and something of value has to be transferred between the parties in order for the contract to be enforceable. It has to have a clear identification of the property's description, which is why you have to be careful with that legal description, because that legal description that we put into the contract is the actual description of the property. Real quick, I'll give you an example. I had a property listed that I was trying to sell, and the property actually had two addresses due to an error with the post office. So the property itself had two different post offices that were attached to it. So the legal description was the only way to designate where the actual property was. So another thing is that it has to have a payment terms, and it has to have any other significant obligations, such as what Ruth has been stating here with sale of another property, anything else, the terms and conditions that are included outside of just the financing. And this applies to purchase agreements, leases, mortgages, easements, and covenant restrictions. Okay, so all of that must be in writing, and that's why we need to do property history so that we know what any encumbrances there may be on the property. The other part is what happens when you add furniture to the contract. So when you add furniture to the contract, that falls under a completely different set of laws, and that is called the UCC, or Uniform Commercial Code. So now you leave the door open for a friction to occur between the buyer and the seller. So if it's a cash contract, whatever. If it's a finance contract, you could have a problem. So that's where the reason why all of this is required, and why it has to be so detailed and perfected in the contract, so that you have a solid, enforceable contract for both parties. And that's all I have to say.
Okay. Anybody have any comments about what Frank just said?
So what is the best way to handle furniture when there is financing? Would it be just an addendum that you don't include in the contract?
I'm going to be honest, my way is not the typical company policy way. Okay, my way is that it should be on a bill of sale, separated from the property, and that the buyer and seller agree on whatever value that might be, or the transfer of ownership of that personal property is given to the buyer in writing in some way, separate from the contract. So that's my way of doing it.
Okay, Jeff, what is your way of handling it?
Jeff's not on. He had to jump on.
He jumped off. Okay. We had Tony Barrows cover this a few months ago in a session he did specifically on furniture. So I like the bill of sale approach. It's not something that we as a company had really been using. More and more of you are moving to that. As a company, we had done an addendum that wasn't identified. It didn't have a letter. It didn't have a number. We've done it that way and kept it out of the contract. So furniture needs to be kept out of the contract because it can affect the appraisal. So I like the bill of sale approach. I think it's cleaner.
Also, in the state of Florida, you are required to have a license to sell furniture.
Yeah, but I don't get so concerned about that, Frank, honestly, but I do. I just want the furniture not to impact the appraisal in any way. And again, if you're dealing with furniture, you better have an inventory.
And yes, absolutely, you're right. I mean, no, it's the chances of you getting called out on that is slim to none. But it also is furniture is probably the most common friction point when deals fall apart.
Absolutely. The other thing too is one of the things we talked about in that session is when I see a lot of you, and we're trying to move you away from it. If you say furniture as shown in the MLS, you can't do that. The reason being, those photos were taken maybe 3 months ago, maybe 6 months ago, maybe a year ago, depending on what's going on with the listing. Okay. So what the best practice is to say furnishings as in place at the date of showing.
That's an excellent point.
Yeah, don't use the MLS because the seller, they're not under contract. There's nothing in the MLS is just an ad. Okay. There's nothing legally binding in there. So the sellers had the property for 3 months or 6 months, and maybe they've moved furniture out. Maybe they're going somewhere else and they're changing out the furniture. So it can't be that. It has to be on the date of showing. So make sure that you keep track of the date that you showed the property, if indeed it's going to be furnishing is going to be included. But always, when you take a listing, make sure that you have a clear definition between you and the seller, if you're the listing agent, is what do they mean by furnished, and make sure that there is an inventory or an exclusion list quickly from the seller, because I agree with Frank. I've seen more deals get hung up over furniture issues.
Nothing brings out ugly like furniture.
Yeah, it's true. Ugly comes out right away, and it can be over some really minor things. But
we had one deal last year that blew up over a comforter.
Yeah. I had one that almost blew up over a rooster statue.
Yeah.
So,
So I do want to add that having an undesignated addendum is not illegal. Okay,
no,
it's
it's
you're
not.
not doing anything wrong. It's just a bill of sale is a separate. I like the bill of sale because it's
I do
separate.
too.
You have to itemize everything.
Right.
So
I agree 100%.
that's all I have to say about it.
Okay. Yeah, that's the direction we want you to all move in, is the bill of sale. I just think it's cleaner and it's a better way to go. But if not, if you're going to use the addendum, then just don't identify it, but be very careful that it doesn't go to the lender.
Yeah. So that bill of sale would have just the inventory, not inventory list attached, but just the inventory on the bill of sale.
Yes,
You
signed by
have the
buyer
name
and
of the
seller.
buyer and the seller, and the stating that the seller is releasing the following property to the buyer. And that could be for consideration, maybe they're actually buying the furniture, or, for to make it legal, I would put the sum of $1.
Okay.
But I'll get a sample of a bill of sale, okay, from one of our attorneys.
That'd
And
be great. Thank you, Ruth.
what I can do is we can put it in sales meeting, so you'll all have it.
Yeah, great. Thank you.
Okay.
So if you have that bill of sale filled out, you don't need to get an exclusion list then, correct?
Correct.
Is it not easier just to get an exclusion list?
Well, well, yes and no. I mean, if it's something where there's just a few items that the seller is going to take, it's easier to get an exclusion list. But you still have to document in the bill of sale what is going to go in that, what is being transferred to the new owner in the house, what's conveying.
So you've got to go through and list every piece of furniture, every silverware, pots and pans, all that stuff?
No. We'll talk about that, I think, in a separate discussion, Trish.
Okay.
Okay.
Because I haven't been asked that question when it comes to the exclusion list, so that's why I'm asking.
Yeah, we'll get you definitions and how to handle a bill of sale, okay?
Okay, sounds good.
Okay. Questions? Anybody else have any questions about anything? No? Okay, well, we ran over. Thank you all for participating today. And again, I will add the slide that's missing. I am putting all the slide decks in Bay, and Frank is putting all the recordings. You'll see it. He's got all of that going on YouTube, correct, Frank?
Yes, it is. This is good stuff, Ruth. I think a lot more agents should have been on here for this one.
I agree.
Yeah, I agree.
Thank you, Ruth.
We can always do it again. So, all right. Thank you all. And if you have any questions you think of later, call me, call Frank, call Jeff, and we're happy to answer your questions.
Thank you.
Thank you.
Thank you.
Thank you.
Okay. Thank you guys. Take care.
Bye.
All right. Bye.